Is that the best way of looking at a smooth bonus portfolio, or the appropriateness of it in a retirement fund?
Yes. So look, I think there's different uses of smooth bonus funds. So I think we must maybe then just unpack, because also you've got the benefits of smoothing, and we'll unpack that a little bit. And then you've got also the guarantees, if you want them at specific points in time.
Can a guaranteed fund, or let's call it a smooth bonus portfolio, ever experience or deliver a negative return to members?
Yes. It depends on what portfolio you've got, and it also depends on the provider as well.
What is your timing? I mean, Sanlam says 2 years to pass on full returns. What is yours? Is that a valid question or a reasonable question?
No, I think it's a very important one. In fact, I would go further and say, to have a look at how the smoothing is done, and also to get sight of the formula.
Hi, everybody, and welcome back to EBnet.Stream. I'm joined today by John Anderson, who is the Managing Executive at Sanlam Corporate Investments, to have what I'm hoping will be quite an interesting conversation around smooth bonus portfolios and an article that we published around this exact topic. So, John, welcome to EBnet.Stream again.
Natalie, thank you so much, and really appreciate being here chatting to everybody.
Okay, so smooth bonus portfolios, I mean, it does give me a bit of a reflection and a pause for thought and looking back in my career. But for those who don't know, what is a smooth bonus portfolio?
Yes, I think so. Let's start with the basics. So a smooth bonus portfolio is essentially an insurance policy. So an insurer would issue a policy, and that policy would pay benefits, and the benefits would be the returns declared over a period of time. But it's actually nothing other than, if you look under the hood, it's like any other investing in equities, bonds, locally, offshore property, all the types of asset classes that you can get. So it's an investment. However, those investments are housed in an insurance policy. And then the insurance policy dictates how those returns are passed on to the investor over a period of time. And you usually then get a formula to declare those returns. And the way that that's designed is to hold back. So when the markets are running, hold back a little bit of returns. And then when the markets, when there's a market crash, then to use some of that extra return that you held back and give it, so that you provide a smooth return over time. So the first feature of the insurance policy is the smoothing benefit. And then the second feature of the policy is that it can provide guarantees. So at particular points in time, it can guarantee the capital of typically 50%, 80%, or 100%. So in a nutshell, it's an investment wrapped in an insurance policy. But the insurance policy is it's a specific category, a smooth bonus policy, and you can get the smoothing with the formula, and then also capital guarantees. And then there's various features that you can add to it. What I'd also like to say is that it's no different from the way that pension funds used to be run 20 to 30 years ago. So in the early days of defined contribution funds, funds would be pooled, and trustees, in fact, would declare return and also hold back. So unfortunately, you can't do that anymore in a pension fund under the pension fund's balance sheet. So a smooth bonus fund is doing what pension funds were designed to do many, many years ago, just within an insurance policy, and then governed by the Long-Term Insurance Act.
It is interesting in the current market context, right? So we had 2025 where we saw markets run, and we've got 2026, and I don't even feel like talking about the investment returns right now. But smoothing the return seems to be quite attractive right now. And in your article, you talked about smoothing a return as a way to take away this kind of bad timing risk at retirement. I mean, is that the best way of looking at a smooth bonus portfolio, or the appropriateness of it in a retirement fund?
Yes. So look, I think there's different uses of smooth bonus funds. So I think we must maybe then just unpack, because also you've got the benefits of smoothing, and we'll unpack that a little bit. And then you've got also the guarantees, um, if you want them at specific points in time. So I think what you need to do is understand, for managing a retirement fund, you need a long-term investment return. And funds typically try and target inflation +5 over a long period of time. The challenge is, when wanting to achieve a return like that, you need to invest in growth assets. And typically those growth assets then go up and they go down, with the market. The issue with that is that, individual investor behavior. So typically, many years ago, what we would see is that when the markets go down, people would switch out into cash and lock in their losses, and then not go back into the markets until it's too late. So I think the first use of a smooth bonus fund is to try and manage investor behavior, to not have that knee-jerk reaction. It is, however, possible to not use a smooth bonus fund, invest in a portfolio, but then you need to have the will to just control yourself, not to knee-jerk react. And I think to a large extent, I think for the accumulation part of the portfolios, I think retirement funds have actually done a good job on that, but through education, through defaults, etc. So I think the first use case is to manage investor behavior, especially in that growth phase, to the extent that you have a concern that members would knee-jerk react and do the wrong thing. So it provides a mechanism to protect. But the second, and more important benefit is in the 10 years before retirement.
Okay.
And why is that important? Because for the 10 years before retirement, that's typically when you've got the highest balance in your savings. So before that you would have invested 20 to 30 years, but your balance is the largest in that 10 years before. Now you've got a bit of a challenge. You want returns, but you also want to manage the volatility, because you don't know when you're going to retire. Like, often people might have a plan of when they want to retire, but sometimes you're forced to retire early for various reasons. It could be ill health, or maybe changes at the company, or you've had enough and you want to do something different. When you retire, you actually trigger an event that I will take my capital. So, and it's at those trigger points when the risks actually become a real issue, because it's okay for when you're young, and you're accumulating assets and the markets go up or down, because you're not going to access them. But 10 years before, like at the period at retirement, when there's a trigger event, a transaction that's going to happen, the volatility does matter. It matters when you cash in, when you transition at retirement, purchase that annuity. And smoothing protects you during those periods, when it matters most. And that's also when the guarantees really, really do matter. And the last couple of months is no different. So if we have a look at March was a particularly bad month. So we saw returns of -10 in the markets. Even bonds gave you -7 to 8%. So it didn't matter where you were invested. But and if you had to retire for whatever reason in March and buy, you take your lump sum for tax purposes, and you also then buy an annuity, you would have had to do it when the market had, at a lower point. The smooth bonus protects you in instances like that. And the same would have happened for the dot-com bubble if you retired during that period. The financial crisis, 2008, 2009, would have protected you over there. And then there will be another crash. We just don't know exactly when it will be, but that's the benefit. And then what we've also seen is that, so for that period at retirement, it's quite important. But what I found quite interesting is that many life stage strategies phase you down from a high growth portfolios to low growth and, heavens forbid, even cash at retirement. And what we did is we did an analysis of under different market cycles over the last 20 to 30 years, comparing different types of life stage strategies. So life stage is good. So it is a good idea to phase from a high growth strategy into something that mimics what you're going to be doing in retirement, and try and have something that's less volatile for the reasons that I've mentioned. The challenge is that a typical life stage strategy goes into low growth assets. So for the 10 years before retirement, you're structurally starting to invest in lower growth assets at a period when you've got your highest balance, when the benefits of high returns matters. You can have the biggest, so you're sacrificing quite a lot of return to manage that volatility. The beauty of a smooth bonus portfolio is that you can still invest in maximum growth assets. And then the insurer would, through the policy, smooth those returns for you over a period of time. So you still remain invested in high growth assets, getting the good real returns, but you get the smoothing benefits in the 10 years. And even though smooth bonus funds have a capital charge to charge for the smoothing and the guarantees, on a net of fees basis, you're still better off than a typical life stage strategy phasing into low growth or cash. And the benefits that we've modeled over different periods is anywhere from 1% to 4% per annum.
Cool.
And if you compound that, that's pretty significant. Then the last benefit is in retirement. So often what happens is a lot of people use, you'll either buy a life annuity. So a life annuity would guarantee your income for life. But if you go and invest in a living annuity, you invested in the markets, and you would be also exposed to the ups and downs of the markets while drawing an income. So again, you're going to be taking money. And if you're taking money when the markets are down, you're crystallizing those losses. So what living annuitant providers and advisors would typically do is invest you in a more conservative asset allocation to manage that risk. Again, sacrificing returns. So if you're investing your living annuity in a smooth bonus fund or have a core part of it to manage it, you can still invest in higher growth assets when you're living annuity while drawing an income, get the better return, and the insurer smooths it for you. And our modeling shows that by doing that, compared to a typical living annuity, on a net of fees basis, you can benefit about 1% per annum. And that's quite significant if you compound that over a period of time. So in a nutshell, manage investor behavior in the early years, from the vagaries of the market and making the wrong decision. But the biggest benefits are the 10 years before in a life stage strategy, so that you can remain invested in growth while managing volatility. And then post-retirement, you can remain invested in growth while drawing an income. And the benefits are quite compelling.
Listening to what you're saying and thinking about the recent market volatility, I'm going to ask you a quick yes or no question. Sure. before we look into some other very important points that you've raised. Can a guaranteed fund, or let's call it a smooth bonus portfolio, ever experience or deliver a negative return to members?
Yes. But it depends on what portfolio you've got, and it also depends on the provider as well. Okay. So, for example, at Sanlam, with our smooth bonus portfolio, we've never declared a negative return. Other smooth bonus providers have, for various reasons. So it depends on the solution. It depends on the philosophy of the particular provider. And because it all depends on the smoothing mechanism that's used. So also, if you've got a smooth bonus portfolio with a guarantee, that's typically a stronger promise. So in that instance, then you would not expect, that to happen, especially if you've got a 100% guarantee.
Mm.
However, these days you're getting new types of portfolios, smoothing only solutions. So there's a lot more. Instead of providing smoothing and a guarantee, some providers are now just providing the benefits of smoothing, which is a huge benefit. So you can invest in the assets and just provide smoothing. For that particular type of portfolio, you can expect negatives, but they're typically very, very seldom and they're very small. But the proposition there is really we're trying to smooth the returns over time, not provide guarantees. And then from time to time, maybe once every 10 years, you might find a month that there's a negative, but it's very, very minimal. But like I said, I think the way that we've run the portfolios at Sanlam, the way that the smoothing is done, and just the mechanisms used and the way the funds are invested, we don't do that, but it is possible, especially for smoothing only type of portfolios. But it's the frequency of it is very low. Yeah.
EBnet is proud to bring you top quality content from experts across the financial services industry in South Africa and internationally for free. Your support helps us in doing this. All we ask is that you subscribe to our channels by clicking the subscribe button below. Share this video with others you think will benefit from it, and give us thumbs up if you are enjoying the content. That way, you help us help you. Thank you from the team at EBnet. For more great content, please visit www.ebnet.co.za.
And obviously it's a much more muted negative, versus a real kind of a real feel in terms of what the market's doing. It's interesting. This concept of investment risk is obviously a big deal in defined contribution funds. And when you've got members accessing savings pots and interacting with their funds every year, they're far more, we're seeing, and I mean, I think the whole industry is seeing members are being far more vigilant of their returns. And so a smooth bonus portfolio really does present an opportunity to trustees to, as you say, manage investor or member behavior, and certainly manage investor disappointment, whether you're accessing a savings withdrawal benefit or a retirement benefit. But for every good thing, there must be compromises made. And so maybe for a minute or two, we can kind of explore the trade-offs that trustees need to be aware of when looking at these types of smooth bonus portfolios.
Yes, no, absolutely. And you also need to make sure that you're using it in the right areas. So for example, using a guaranteed fund for all members from when they're young all the way through to retirement is not appropriate for all funds. There are certain funds that might be, but most funds would have like a life stage strategy. And I would argue that, for the accumulation phase for funds that are bought into that type of strategy, you don't need smoothing. The markets will smooth for you because you've got time on your side and you're investing money and contributing positively. So it's not really, and especially if you've got the communication right with members, not to knee-jerk react, which we have seen. Most people stick to the defaults, even through COVID, we've seen it. Then there isn't really benefits. If it's really that 10 years before retirement, when the transactions and you start phasing down and the triggering. The trade-off, so let's then talk about the trade-offs. So the first thing is it comes with additional costs. So that's an important aspect. So what trustees need to weigh up is the cost and the benefit. So for smoothing, so let's start off with the underlying portfolios would be managed the same. So you've got traditional asset classes as you would have in any other portfolio. So that's the same. And I think one needs to make sure that the fees for the underlying fund management is competitive relative to what's happening. You also need to make sure that the returns are being managed professionally. Some of the criticisms in the past has been that those monies have been invested more for the benefit of the shareholder, meaning the insurance company, so that the guarantees don't kick in. And then it becomes a conflict of interest. So the first thing is you need to check is this conflict of interest issue. But the good news is that in modern smooth bonus portfolios, that's no longer the case. It's managed transparently, very well, and not to the benefit of shareholders. It's rather get the best return for clients. And then, yeah, you make sure that the capital charge that's there is commensurate, with the risks involved. Now, that capital charge is quite important. You need to evaluate whether it's fair compensation. It's essentially like a premium. So it's insurance, right? So either at a 50% guarantee level, or 80 or 100. For a 50%, you would expect a low premium because you're getting low protection. For an 80% guarantee, higher cost, higher premium. For 100, it's got and the trade-off you need to make is that the cost of that premium versus the benefit. And that's why usually, especially with the high guarantee, it is very beneficial in that last 1 or 2 years before retirement. And you'll only be paying it for 1 or 2 years when you really, really need it. If you're paying that for 40 years, then you need to evaluate whether it's appropriate. Some funds maybe, but for most funds, it's more appropriate just to use it targeted for that 1 or 2 years. And then you need to evaluate the potential downside. For example, when we saw like the financial crisis in 2008, 25% downturn of returns. Now you're comparing like a potential 25% downturn versus paying a premium of, let's say, 1% for 2 years. I think in that instance, the pros and cons speak for it's worth it. But it might not be worth it for 40 years because over time, that 1% per annum capital charge erodes more than it adds value. To give you an example. So evaluate the cost, make sure that it's beneficial. But I would also, the ones that are used the most often are the smoothing only. And I also categorize the 50% guarantee solution as a smoothing only because the chances of a event happening that you'll lose more than 50% of capital and then not get it back through the time in markets is incredibly low. So the real benefit of a portfolio like that is actually more the smoothing benefit. And typically a capital charge would be like 20 basis points. So you need to compare, is that 20 basis points that you're paying worth? And in our view, that for that 10 years before retirement, if you're comparing a typical life stage strategy invested in 30-40% in growth assets versus a smoothing only portfolio that you can invest in 80% in growth assets, that difference between 80% growth and 40 gives you an extra return for that 10 years in retirement. That extra return that you're going to get far outweighs the 20 basis points. So on a net of fees basis, it's definitely worth it. Then the other thing you need to also look at is transparency. So previously, many years ago, smooth guaranteed funds were criticized because it was a black box. Nobody understood how the actuaries are calculating these formulas. And that is a fair criticism, I think, of the historical products, because you don't know, are you getting a fair return? Are you getting a reasonable return? And then the return, shareholders versus members, are they getting the right outcomes? The more modern portfolios address that through quite a lot of transparency. So you're able to now have most smooth bonus portfolios these days will show you what the smoothing formula is, and it's managed according to a formula. It's not just a gut feel black box. And those insurers spend quite a bit of time to engineer those formulas to pass on the returns in a fair manner between different generations of members. Because that's what you want, is you want different generations of members to benefit as soon as possible. You don't want to hold back too much when the markets are running. And you also want to make sure that you do protect enough, on the downside. So having a look at that formula, that's quite important. And then also the disclosure of the returns, looking at the underlying. So these days, what would happen is you won't just get the total return, you'll also get the building blocks. So just like when you have an investment report back, trustees should unpack. Are you getting a competitive return from your equities, bonds, cash, the whole portfolio? Then you have a look at the benefit of the smoothing mechanism and the formula, and make sure that that is appropriate. And then you have a look at the fees. And then the last trade-off that I do want to mention is, the issue of sacrificing of returns when you disinvest. So there is an issue that because in a smooth bonus portfolio, you get this concept of, we all know what market value is. It's the market value of your underlying assets on a day-to-day basis. A smooth bonus portfolio would have what's called a book value. The book value is the value that's today, it's the smoothed value, and it can be higher or lower than the market value, depending on the period of time. And it's really the book value that's passed on over time to investors to smooth. Now, if the markets have run hard, you can find a situation where the market value of the underlying portfolios is higher than the book value. And if you were to disinvest the full portfolio at that particular point in time, you essentially lose the difference between the market and book value. So that is something you need to consider. So if a fund is moving in terms of a Section 14 or moving from one umbrella to another, that is something you need to look at, because you would be sacrificing the difference between market and book value at a particular point in time. What you need to do is evaluate whether that sacrifice is worth where you're going to, that it's beneficial. Right. But also there are mechanisms to manage that over time. These days, through your consultant, you can manage, between the old portfolio and the new portfolio. New money can go into the new portfolio, whereas old money can be ring-fenced so that you don't lose that difference. But you can also, through negotiations with providers, ring-fence the money. And through Section 14s or even retrenchment exercises, when big money is leaving, to try and get a fair outcome for members. So it is a little bit harder to move it in big tranches if you're wanting to do full disinvestments or surrender. So I think those are ones, but I think are there other ones that you'd like to unpack as well?
So it was interesting. It's interesting to me because there's almost this element. You talked about generational. To me, I hear the word cross-subsidization, right?
Yes.
I might have had money in the fund last year in 2025. Markets ran at 40%. You gave me 35%, which means I've kind of left some behind for somebody who might join the fund this year. And I'm hearing you say trustees and investors should monitor how quick the passing on of that return is.
Yes.
Okay.
That is absolutely the case. And that was the criticism when we talked about pension funds going back 30 years. That was the problem. Pension funds used to smooth returns.
Exactly right.
The problem is that they used to do it they took a very conservative view. So they held back too much, so that people that were exiting, so that people that were resigning, being retrenched, didn't get the full value of the money. It was really left behind, and then that got distributed, and it actually built up surplus. So what you don't want is large portions of surplus to build up over time in these funds. So that passing of returns, that formula, and how the insurer does it is extremely important. So what you want to do is you want to pass on the returns as quickly as possible, so that if there's a market run, you want to pass it on quickly. But you don't want to do it that quickly that if there's a market downturn, that you now need to declare negative. So the art is really there to make sure that those smoothing formulas pass on a good return over a period of time. but also hold back enough to protect in the downside. And what we try and do is we try and pass on returns really over a 2-year period to make sure that it's fair. And we actually find that that actually works very well. But you do need to check. You definitely don't want surpluses to build up over time.
Yeah.
At the same time, you also don't want insurers to be irresponsible, declaring too much, so that when there is a market downturn, now you're going to experience a negative, which you don't expect typically from these portfolios. So it's a tricky balancing act between those. Yeah.
There's certainly an art to it. And could a trustee ask an insurer? You've just said 2 years. If I was sitting in a trustee meeting, am I able to say to an insurer who's talking to me about smooth bonus portfolios, what is your timing? I mean, Sanlam says 2 years to pass on full returns. What is yours? Is that a valid question or a reasonable question?
No, I think it's a very important one. In fact, I would go further and say, to have a look at how the smoothing is done, and also to get sight of the formula, but then to get the insurer to actually explain the formula. Because I'm sure it can be quite intimidating looking at it, but you need to then have a look at that formula, how it behaves in different market cycles. So how would it behave in a market, a bull run? How would it behave in a downturn and different cycles, so that you can get an evaluation of how would it pass on the returns over time, and would it be doing that in a fair and reasonable manner? Very important, though, is we must just go back to a pension fund is a pooling vehicle. So by its very nature, it is a pooling mechanism. So there's lots of cross subsidies in a pension fund. Because you've got pooling, you can get better fees negotiated, and also even the admin fees that you pay. Some pay more than others depending on how you do it. But I think what a smooth bonus is trying to do is to pool investors, and then also provide the benefits over time. And if you stay within the fund over a long period of time, you should be no worse off had you got market or book value. The challenge is if you chop and change quite a lot, if you join a fund and resign, but typically people stay longer than 3 to 5 years, and should, in the fullness over that period, get a reasonable return. So I think those are the things that trustees must look at. A typical member, when they join and exit, would they get a reasonable return outcome? Not just for the 40-year period, but also for those, when they change jobs. And then, I think what is very important, though, is to have a look at how these portfolios would behave in downturns, because there have been some solutions out there that promised smoothing, but then when the market downturned in COVID, for example, declared a negative, which is definitely not what investors would have expected or trustees would have expected. So I think one must learn. That's why you need to understand the philosophy of the provider. How would they behave in certain instances? Because if you're going to, as a trustee, promise certain return profile to members, you want to make sure that your portfolio behaves like that. So you need to be very careful about how this thing is done. So ask your advisor, to unpack all of those things for you. So it's definitely worth it, but you need to understand all these little intricacies. But you also need to make sure that you're using. See, what I've found in practice is that smoothing and guaranteed funds were maybe also used in the wrong places at the wrong time. So it's for some funds, having a one size fits all with guarantees in place makes sense. And that's a certain profile of member that doesn't want to experience, they do want to have the guarantees, and then they understand that it does cost extra, but it's for this profile of members. But for your typical defined contribution member, where there is member choice and using life stage, you need to target it in that 10 years before retirement. And then I do think that having a guarantee for those last 2 years, even though it costs more, is beneficial, but you're only paying it for 2 years, not for 10. So in my view, smoothing is underutilized in the market. And I would challenge advisors, go and have a look at, your life stage strategies and have a look at, are you getting the right return using an absolute return fund, a conservative fund, or cash versus something like this? And you probably find that you can do better, with this, but make sure that it's with the right provider. And very important, make sure that the underlying portfolio is managed to get the best return outcome, because the historical things and also the criticisms in the past is that it was invested by the insurance company, and it didn't have to give you competitive returns. But these days, I think, the way that we manage it, for example, is after the deal with 91. So Sanlam Investments sold 91, active management to 91. And we now manage our underlying portfolios on a best of breed basis. So it's not this lazy insurance company assets, that it's actually managed very competitively to give you competitive returns with the best asset managers that, to offer. And you can also invest in things like private markets, etc. And that's different, from the past. So last criticism was just the underlying returns often weren't competitive, but for the modern portfolios, it's managed just like a typical balanced portfolio. The difference is you've got the policy wrapping it. But hopefully that gives you a good tour of the key things to the trade-offs you need to make. Yeah.
It does, and it almost makes me want to suggest that perhaps the new and the more modern life stage default is going from a 50% guaranteed smooth bonus portfolio up to an 80, up to 100 as the member, him or herself, transitions closer to retirement. I mean, is there an argument to kind of say to trustees or management committees out there, go smooth bonus and just manage the underlying guarantees?
Yes. So I definitely would say that that's beneficial. So, but the starting point is have a look at your strategy at the moment. Most life stage strategies go from a balanced fund. We can talk about that at some other stage, that maybe the balanced fund isn't high growth enough, especially with the two-pot system, but that's a story for another day. But in that 10 years before retirement, if you phase down to low growth, and you can do the math, and I think I would challenge trustees, go and speak to your advisor, have a look. If you replace that end portfolio or the smooth, the phasing down portfolio, you replace it with a new age smooth bonus portfolio like the one that we will be making available from June this year to the market. The smooth bonus, it performs better for a couple of reasons. Instead of investing in low growth assets, it's invested in 80%. And it's also very diversified, local, offshore, a combination of active, passive, and private markets, and will perform just as well as your accumulation portfolio. So you're actually getting your accumulation portfolio wrapped in a policy, so you can get those same returns for the last 10 years. The difference is that it's smoothed. So the first step is make sure that you at least have the smoothing. Because also it's the lower cost option where you have a 20 basis points smoothing fee, but the 20 basis point fee is more than worth the extra exposure that you get to growth assets. And you will definitely find for that 10 years before retirement, imagine you can now invest in 40% more growth assets for 10 years.
Yeah.
And you've got the smoothing, and the smoothing does a better job. Its volatility is lower than a typical absolute return portfolio or a conservative portfolio. So you get the best of both. You only need to just manage that trade-off of, if you were to on bulk move the members, that difference between market and book, So that's the trade-off. But even then, it's worth it because you're invested structurally in higher growth. So then what you should do, as you say, consider where you want to target the 80 and 100% guarantees. And you could do that gradually closer to retirement. The reason for not having the 80 and 100% guarantee throughout is it costs more. And it does start adding up. So if you can just focus it for the last year or two for that 100% guarantee, it is then worth it because it's the insurance premium for when the markets go down. And our research has shown that when you interview people close to retirement and in retirement, that guarantee gives you peace of mind. Imagine you had to retire in the financial crisis. You would be panicking, and this is your life savings. So that guarantee does help. So I think what we're trying to say is just life stage works. However, there's new technology available to start incorporating smoothing in the 10 years before and then targeting guarantees in the right places. And if you do the comparison of that strategy versus a traditional, it outperforms over time. To us, it makes a lot of sense. And then for your in-fund annuitants, for your living annuitants, that's one we didn't talk about, but instead of investing in this, you can also, the smoothing definitely helps for your in-fund living annuitants, as well as if it is out of fund with a list provider, we are seeing as well on the retail side, advisors using smoothing as a core portfolio to manage that. And it just makes a lot of sense. So I think it's just important that trustees look at the new technologies, new techniques available to them, and you can eke out extra value for members. But you need to just understand the dynamics and just make sure you're managing the extra complexity that comes in here. But that you can do with your advisor.
I think just to wrap up, because we have run out of time already, but just to wrap up, thinking about the most recent Sanlam benchmark survey, we saw an interesting or a very concerning, in my opinion, stat around the number of funds who still offer a cash portfolio. That's the ultimate portfolio just before the member retires. And I think what you've sketched is a very compelling solution to that, or alternative, which does give the retiring member access to high growth assets, but still protects him or her from the market movements, which is exactly what you want. And you can then go and mimic in your annuity anyway. And so thanks, John. You've really unpacked it for me and really helped trustees ask the right questions, because these portfolios, I think, in the past have gotten a bad rep. And it's important to understand, like you say, the evolution. As the technology gets better, markets get better, portfolios and product design gets better. It's very important to understand the evolution of what's out there. So thank you, John. Thank you for spending the time with EBnet Stream today.
Absolute pleasure. Thank you so much.